In today's video, we're diving into the dark world of legal tax loopholes, strategies that the IRS hates but can't do anything about because they follow the letter of the tax code. The IRS doesn't want average taxpayers like you knowing about these maneuvers because then they have less money coming into their coffers. But secrecy only benefits the rich. So we're here today to even the playing field and let everyone in on these insider tricks. Let's start with a quick background on how loopholes come to be. The tax code in the US is over 74,000 pages long and constantly changing as new laws are passed. With that level of complexity, it's inevitable that unintended consequences and ambiguities creep in. Smart tax attorneys and accountants find and exploit these gaps, seams, and inconsistencies. Then they design strategies to take full legal advantage. The trouble is, by the time the IRS realizes what's happening and moves to close a loophole, wealthy clients have already reaped millions in savings. A perfect example is the step-up in basis loophole. Normally, when you inherit stocks or real estate, you have to pay capital gains tax on any increase in value from when the original owner purchased it to when they passed away. But there's a flaw. The tax code allows heirs to step up the cost basis of inherited assets to their current market value at the time of death. So even if Grandpa bought Apple stock for $5 a share in the 80s that's now worth $150, the heirs pay zero capital gains tax when they eventually sell, as if they got it for $150 too. The IRS hates this one because it's led to untold billions in unpaid taxes. But lawmakers have so far refused to close it because the wealthy have lobbied hard to keep this back door open. Another sneaky trick involves using opaque business structures like limited liability companies or S-corps to convert wages into profits. Doing so allows owners to deduct 20% of qualified business income right off their taxable earnings. On paper, it looks like you made $100,000 in profit from your business. But with the QBI deduction, only $80,000 of that gets taxed like normal income. The other $20,000 is shielded. The IRS is still fighting to crack down on fake small businesses set up with no true purpose except dodging payroll taxes this way. Yet our favorite loophole involves good old-fashioned tax havens. Countries like Panama, Switzerland, and even Puerto Rico have established themselves as offshore banking and investment centers precisely because they impose little to no taxes on foreigners. As long as you keep your money offshore and only bring profits back to America, you can avoid a lot of IRS oversight, and any asset appreciation in these havens compounds tax-free for generations. The strategy: open an entity like an international business corporation in one of these havens. Transfer IP rights, trademarks, shares, or other assets into the company. Have the offshore corporation license your intellectual property back to your U.S. company at below market rates. Your U.S. company pays fees or royalties to the offshore company, deducting the payments and shifting profits away from the IRS grasp. Meanwhile, the offshore stash grows untaxed, and access it whenever you please using loans against the offshore assets. Now, we know many of you watching are probably thinking, this stuff sounds shady or like tax evasion, but we cannot emphasize enough that everything we've shared so far is completely above board and endorsed by the U.S. tax code as written. Moral objections aside, you have a duty as a citizen to legally minimize your obligations to Uncle Sam. The key is to stick to strategies that the wealthy have successfully lobbied into law and to not cross any bright legal lines. As the saying goes, it's only cheating if you get caught. Okay, with the preliminaries out of the way, we'll dive into a few more advanced techniques that get into loopier loophole territory. One involves exploiting a quirk around capital losses. Normally, if you sell an investment for less than you paid, you can use that capital loss to offset capital gains in the same tax year or carry it forward to reduce taxes in future years gains are realized. But there's no limit on how many losses you can use in a single year. So sophisticated investors will intentionally realize large capital losses just before year-end to wipe out tax bills on gains realized earlier that same year. That resets their capital loss carry-forward amount, allowing them to pocket millions in untaxed profits the following January. The IRS is basically powerless to crack down since short-term wash sales or losses taken just to minimize tax are technically allowed. Another involves creative donation strategies. Wealthy donors have learned that while you can only deduct 30 to 50% of your adjusted gross income each year for charitable gifts of cash, There is no annual limit for donations of appreciated assets like stocks or real estate. So at year-end, donors who've maxed out their cash deductions will give 6- or 7-figure investments directly to nonprofits. They deduct the full current market value and pay zero capital gains tax, all while receiving a PR boost for their perceived generosity. The nonprofit then promptly sells the assets, gives the donors some money back under the table, and everyone comes out ahead financially thanks to the tax breaks, with the IRS none the wiser. It's a classic case of getting something for nothing through exploiting statutory loopholes. And believe it or not, even tax evasion itself has loopholes you can legally take advantage of. Using foreign trusts and offshore structures, the wealthy have sheltered hundreds of millions in unreported income by exploiting statutes of limitations. Under current law, the government only has 3 years to audit your returns and assess penalties once a return is filed. So some use offshore payment processors and wire everything abroad just before April 15 falls every 4th year. Their U.S. companies show no profits, no taxes are owed domestically, and by the time the IRS realizes money has left the country, it's too late for them to take action. They get away scot-free with tax-dodging sanctions. Sharing these loopholes candidly is to level the informational playing field. Tax savings should not exclusively benefit the 1% who can afford high-powered advisors. Every citizen has a right to understand and take full legal advantage of the rules as they currently exist. Thanks for watching. Be sure to like, comment, and subscribe if you learned something new or found this video interesting.